So picture this. You're 26, maybe 27. You've got a decent job, nothing glamorous, but it pays the bills, covers the rent, maybe leaves you with a little extra at the end of the month after you've ordered too much takeout and justified a streaming subscription you've used twice. And somewhere in the back of your mind, there's this quiet voice that says, I should probably be doing something smarter with my money right now. But then life just keeps happening. There's a birthday trip with friends. Your car needs new tires. Your cousin's wedding is in April and you're in the wedding party, which apparently means you're buying a dress that costs as much as your phone bill. And so the doing something smarter thing gets quietly pushed to next month, then the month after that. And then somehow it's been a year and a half and you still haven't really started. I think about this a lot. Honestly, more than most people would find normal. My name is Emmy, and I spend way too much time thinking about money, about financial psychology, and about why some people seem to effortlessly build wealth while others stay stuck in the exact same financial patterns for decades, spinning their wheels and wondering what they're missing. And what I keep coming back to, over and over, is this idea that's almost uncomfortable to say out loud. There are certain windows of financial opportunity in your life that are genuinely, irreversibly time-sensitive, not in a scary, fear-mongering way, but in a very real, very mathematical, very human way. And the biggest one, the one that I think people most dramatically underestimate, is the window between roughly your mid-20s and your 30th birthday. Because something shifts when you turn 30. Not immediately, not overnight, but the conditions that make certain financial moves extraordinarily powerful, they start to quietly erode. And most people don't realize it until they're on the other side of it, looking back, wondering why nobody told them. So that's what this is. Consider it the conversation I wish someone had pulled me aside and had with me when I was 25, and spending way too much on brunch and not nearly enough on my future. I'm not here to make you feel bad, I'm here to make you feel informed, because there's a real difference. The compound interest thing isn't just a cliche, it's actually insane. Okay, I know, you've heard about compound interest. You probably heard about it in a high school economics class, and then immediately forgot it because there were more pressing things to think about, like whether your crush noticed you or whatever. But I need you to actually sit with this for a second, because when you run the real numbers, it's one of those things that genuinely makes your stomach drop. Here's a simple example. Let's say you're 25 years old and you start investing just $200 a month. Nothing dramatic. That's maybe cutting out a couple of dinners out, canceling a subscription or two. You put that $200 a month into a basic index fund. We're talking something boring, like a fund that tracks the S&P 500, and you average, historically, around a 7 to 8% annual return, which is the rough long-term average before inflation for the US stock market. By the time you're 65, you'd have somewhere around $500,000, maybe more, from $200 a month. Now let's say you wait. Not forever, just until you're 35. 1 decade later, you invest the same $200 a month, same return, same discipline. By 65, you'd have roughly half of that, maybe a little more than $250,000. Half the outcome for waiting 10 years. That gap, that $250,000 gap, is what compound interest does when it has more time to work. It's not just growth on your money, it's growth on the growth, which is growth on that growth. It's exponential, and exponential math is genuinely one of the things human brains are worst at intuitively understanding. We think linearly. We think, if I wait 10 years, I'll have 10 years less savings. But that's not how this works. Waiting 10 years in your 20s costs you exponentially more than waiting 10 years in your 40s. The early years are disproportionately valuable. And here's the thing that nobody really emphasizes enough. The money you save in your 20s is worth more than money you save at literally any other point in your life. Not because you're special at 25, but because time is the ingredient, and you are running out of it in a way you can't really feel until it's gone. I remember the first time I actually sat down and ran these numbers for myself, like properly with a calculator, not just vibes, and I had this moment of genuine, slightly panicked clarity, because I could see exactly how much my "I'll start later" mindset was actually costing me. And later wasn't some abstract future, it had a very specific, very expensive price tag attached to it. So if you're in your 20s and you haven't started investing yet, or you've started but you're not consistent, this is the section of the video where I need you to really internalize one thing. Every single month you wait isn't neutral. It's costing you something. Not because you're failing, not because you're bad with money, but because time in this context is literally the most valuable asset you have, and it is the one asset you cannot buy more of. Your risk tolerance has a secret expiration date. Here's something that doesn't get talked about enough. The way you're allowed to invest, or more accurately, the way it makes mathematical sense to invest, changes dramatically based on your age, and the 20s are actually the most powerful time to take on investment risk. Let me explain what I mean. When you're 25 and you invest in a broad stock market index fund, you're taking on what investment people call market risk, which is a fancy way of saying your investments will go up and they will go down, and sometimes they will go down a lot. The 2008 financial crisis, the COVID crash in March 2020, these were terrifying moments if you were watching your portfolio. The market dropped 30–40% in a matter of weeks. But here's the thing, if you were 25 in 2008 and you just kept investing and didn't panic sell everything, within a few years, you had not only recovered everything you lost, you had gained substantially more. Because a market crash at 25 isn't a disaster. It's, weirdly, kind of a buying opportunity. You're buying shares at a discount and you have decades for them to recover. If you're 55 in 2008 and you're planning to retire in 10 years, that's a completely different situation. You don't have the time to wait for a full recovery. You cannot afford the same level of risk. This is what financial advisors mean when they talk about time horizon. And your time horizon at 26 is enormous. It's almost absurdly large. It means you can put your money in higher growth, higher volatility investments, basically meaning your money has the most potential to grow, and you have the luxury of simply riding out the bad years because you have so many good years ahead. After 30, this doesn't disappear overnight, obviously, but with each passing year, the logic of aggressive growth investing starts to slowly shift. By your 40s, responsible financial planning typically has you gradually moving a portion of your investments into more stable, lower growth things, because you have less time to recover from a significant drop. The runway gets shorter. So the window where you can invest aggressively, where it is actually strategically correct to put your money in the highest growth assets, is wider in your 20s than it will ever be again. And most people spend that window not investing at all, or investing so cautiously that they're basically just keeping up with inflation. I had a friend, she was so proud of herself because she'd been putting her savings into a high-yield savings account. And look, that's better than nothing, genuinely, but she was getting maybe 4% interest. Meanwhile, the market over the same period returned significantly more. She was protecting her money from risk she didn't actually need to be afraid of yet. She was using a 40-year-old's investment strategy at 27. The window for aggressive, high-growth investing is right now if you're in your 20s. It closes slowly, not all at once, but it does close, and most people don't realize it until they're standing on the other side of it. The identity shift nobody warns you about. Okay, this one is less about numbers and more about something that I find genuinely fascinating from a psychological perspective, and I think it might actually be the most important thing in this entire video, so stay with me. There's something that happens around 30, sometimes a little before, sometimes a little after, that I think of as the identity calcification point, which is a slightly dramatic name, but just hear me out. When you're in your mid-20s, your identity is still, to a meaningful degree, in flux. You're still figuring out who you are, what you want, what kind of life actually makes you feel good, versus what you thought would make you feel good. And that fluidity, that openness, it's actually one of the most powerful things you have. Because the decisions you make during that period about your career, your financial habits, your relationship with money, what kind of lifestyle you actually need versus what society tells you you should want, those decisions have an outsized influence on the rest of your life. Not because you can't change later, people change all the time, but because the habits and identities you build in your mid to late 20s tend to become the baseline you operate from. If you build the habit of investing automatically before you're 30, it tends to just become part of your life. It's who you are. You're the kind of person who invests. And that sounds simple, but it is genuinely harder to build that identity at 35 or 40, because by then you've got more financial complexity, maybe a mortgage, kids, aging parents, all of it. And the psychological inertia is stronger. Change feels more disruptive. Conversely, if you build the habit of lifestyle inflation in your 20s, if every raise becomes a bigger apartment, a nicer car, a more expensive wardrobe, that also calcifies into an identity, and it becomes the baseline your lifestyle expects. And suddenly, at 35, you're making 3 times what you made at 25, and somehow you're still just as broke, and you have no idea how that happened. I remember talking to a guy once, mid-30s, genuinely successful by most external metrics, good salary, nice apartment, respected in his field, and he was frustrated because he felt like he should have more to show for it financially. And when we talked through his spending, it wasn't that he was reckless or irresponsible, it was that every time his income had gone up, his spending had quietly gone up by exactly the same amount. It was automatic. He'd never consciously decided to live below his means because he'd never built that as part of his identity when it was easy to do so. This is the window that I don't think people fully appreciate, the window where your identity around money is still being written, where you can decide with relatively low friction what kind of financial person you're going to be, where you can build the automatic behaviors, the investments, the savings, the spending boundaries that will serve you for the next 3, 4, 5 decades. After 30, it's not impossible, but it takes more conscious, deliberate effort because you're rewriting something that's already been written, rather than writing it for the first time. The career risk window and why most people waste it. Let's talk about careers for a second, because this is another window that quietly closes and that most people massively underutilize. Here's the uncomfortable truth. The period between roughly 23 and 30 is probably the single best window of your life to take significant career risk, to try the thing that might fail, to start the side business, take the lower paying job at the exciting company instead of the safe job at the boring one, move cities, switch industries, do the thing that doesn't make sense on paper but might be exactly right for you. And I know that might sound counterintuitive, because your 20s often feel like the time you can least afford risk. You might have student debt, you're probably not earning much yet, the stakes feel high. But here's the thing, they're actually at their lowest. Not zero, there are real consequences to choices in your 20s, but your obligations are typically smaller. You probably don't have a family depending on your income yet. You might not have a mortgage. Your lifestyle, if you haven't inflated it too much, is relatively affordable. And if something doesn't work out, you recover faster. You have more time to pivot. You have the energy and the adaptability to start something new. The cost of failure in your 20s is almost always lower than the cost of playing it safe. But something shifts around 30, or at least around the life events that often cluster around 30. The mortgage, the relationship that's serious enough that you can't just upend everything. The kid, the aging parent who needs more support. These aren't bad things, but they are obligations. They are anchors, and anchors make risk harder. I know people who had a business idea at 26 and thought, I'll try it in a few years once I'm more settled. And by 32, settled meant a mortgage and a baby and a partner who needed them to be financially stable, and the idea just never got tried. And some of those ideas were probably bad, sure, but some of them could have been something. And the cost of not knowing eats at people in a way that's hard to fully articulate. The window for high upside career risk closes slowly, but it does close. And the people who use it, who take the swing when the stakes are manageable, tend to look back on that period as the defining move of their financial lives. I'm not saying everyone should quit their job and start a business at 27. But I am saying, if there's a risk you've been thinking about taking that you keep postponing until conditions are better, conditions are probably as good as they're going to get right now, because better conditions often just means more things to lose. Your health is a financial asset, and it peaks right now. This one might sound like it belongs in a fitness video, but stay with me because the financial implications of this are enormous. Your body in your mid to late 20s is operating at its peak efficiency. Your recovery time is faster. Your metabolism is doing things it will never do again quite so effortlessly. Your baseline energy levels, if you're taking reasonable care of yourself, are probably higher than they will be at any other point in your adult life. And here's why this matters financially. The habits you build right now around your health are going to follow you for decades. And the cost of bad health habits in actual dollars over a lifetime is staggering. Chronic conditions related to poor diet, sedentary lifestyle, poor sleep, they are expensive. The healthcare costs are real, the lost productivity is real. The reduced earning capacity when your health deteriorates in your 40s and 50s is real. The cost of medications, treatments, the mental health toll of feeling chronically unwell, these are not abstract. They show up in your bank account. Conversely, the habits that protect your long-term health, regular movement, not smoking, moderating alcohol, getting enough sleep, managing stress, these cost relatively little now and pay out enormously over a lifetime. They're a form of investment that most personal finance content completely ignores. I'm not going to stand here and lecture you on eating your vegetables. That's not really what this is about. But what I will say is that how you treat your body in your 20s is one of the most significant financial decisions you will make, even if it doesn't feel like a financial decision at all. The window where healthy habits are easiest to build, before the chronic stress of middle age sets in, before the bad habits have had decades to compound in the other direction, is right now. And like compound interest, the benefits accumulate in ways you won't fully see for years, but they are accumulating, and so are the consequences if you're moving in the wrong direction. The relationship decisions that permanently reshape your finances. Here's another window that closes in a very specific way around the late 20s and early 30s, the window where your major relationship decisions are still unmade. I want to be careful here, because this isn't a lecture about who to marry or whether to get married at all. Relationship choices are deeply personal, and there's no universal right answer. But there is a financial reality here that I think is worth understanding clearly. Who you partner with, if you partner with anyone, is one of the most significant financial decisions of your life, not because romance is transactional, but because financial lives become deeply intertwined in long-term partnerships. Spending habits, attitudes toward money, debt levels, earning trajectories, risk tolerance, these all get merged, and the research is pretty clear that financial incompatibility is one of the leading causes of relationship stress and breakdown. The window I'm talking about here is the window before you've made those major commitments, when you're still figuring out what financial values actually matter to you, when you can, relatively freely, choose who you want to build your financial life with, when you can have the uncomfortable conversations early about debt, about savings goals, about who wants to work and how much, without those conversations feeling like attacks on an established life you've already built together. A lot of people avoid those conversations. They feel awkward, unromantic, premature, and then they find themselves at 34, married or deeply committed, and they realize they and their partner have fundamentally different relationships with money, and unpacking that is genuinely hard. Not impossible, but hard. The window for clarity, for building your financial values consciously, for understanding what you need from a financial partner, is widest in your mid to late 20s. Use it. Get clear on what you believe about money. Have the conversations that feel too real, because financial transparency, started early, is one of the highest return investments you can make in a relationship. The network window, the asset you can't buy later. Last one, and this one is sneaky because it doesn't look like a financial concept at all, but it is one of the most financially important things I can tell you. Your network, the people you know, who trust you, is one of the most significant drivers of your career trajectory and therefore your lifetime earnings. And the window where networks are most easily built is somewhat counterintuitively in your 20s. Here's why. In your 20s, professional relationships are naturally forming. You're in new jobs, new cities, new industries. People are meeting you when you're young, hungry, and if you're showing up well, impressive. The people you meet in your 20s become the colleagues, collaborators, clients, and connectors who will shape the next 30 years of your career. The mentor who gives you your biggest opportunity, the colleague who starts a company and brings you along, the friend who recommends you for something that changes everything. These relationships compound. A strong connection at 26 leads to an introduction at 30, which leads to an opportunity at 35, which leads to a completely different financial outcome at 45. You can't really see the chain while you're in it, but it's happening. The problem is that in your 20s, networking feels fake or uncomfortable, or like something only certain kinds of ambitious, loud people do, and so a lot of people skip it. They show up, do their job, go home. And that's fine up to a point, but the relationships that would have formed naturally during that decade over shared projects, industry events, casual conversations with interesting people, those just don't happen. By your mid to late 30s, building a new network from scratch is harder, not impossible, but harder. People are more established in their circles, time is more scarce. The natural fluidity of early career networking is replaced by something more transactional and deliberate. It can still work, but it takes more effort for less return. The window for effortless, organic, high-return network building is your 20s. Show up, be curious, be useful to people around you. Invest in the relationships that feel genuine, not for calculated future benefit, but because people remember how you made them feel, and that memory has a very long shelf life. What this all comes down to. So let's pull this all together, because I want to make sure this doesn't just feel like a list of things you should have done differently, or a pile of pressure about a deadline you're already stressed about. That's not the point. The point is this. Your 20s are not a waiting room. They are not the practice round before real life begins. They are, in multiple, overlapping, and mathematically verifiable ways, one of the highest leverage periods of your entire financial life. The decisions you make about investing, about career risk, about your health, about who you spend your life with, about what financial identity you build, these don't just affect the next few years. They ripple outward across decades in ways that are genuinely hard to reverse later. And the thing is, none of what I've described is that complicated. The actual actions, setting up an automatic investment, building a savings habit, taking the career risk when the stakes are low, having the honest financial conversations before they become loaded and weighted with years of shared history, these are not hard things to understand. They're just easy to postpone. And postponing them feels safe and neutral in the moment, when in reality, it's quietly one of the most expensive decisions you'll ever make. I've talked to people in their 40s who, when you ask them what they'd tell their 25-year-old selves, say almost universally, start sooner. Not because they failed, not because their lives are bad, but because they can see, clearly from the other side, what those early years were worth, and they can see how differently things might look if they'd understood that earlier. You still have that view from the other side available to you. It's not too late if you're in your mid-20s. It's not even too late if you're right on the edge of 30. The window narrows, but it doesn't slam shut on your birthday. The urgency here isn't panic, it's clarity. It's understanding that the conditions you're operating in right now are genuinely favorable in ways that won't last forever, and deciding consciously to use them. Start the investment this month, not when you have more money, not when you understand it better, not when life calms down. This month, $50, $100, whatever you have, let it start compounding. Give time the chance to do its extraordinary, completely unglamorous work. Take the career risk you've been overthinking, have the financial conversations you've been avoiding, build the health habits that are genuinely easiest to build right now, show up for the relationships and the network that will quietly, invisibly shape the next decade of your life. You are right now sitting inside a window that is slowly, quietly closing. Not with alarm bells, not with a countdown timer, just with time, doing what time does, moving forward regardless of whether you're moving with it. And the version of you on the other side of 30, they'll either look back at this moment as the time they started or the time they almost did. I genuinely hope it's the first one.